Hello, this is Stephen Gibson with Affinity Wealth Management. This presentation presents highlights of our 6-month State of the Markets presentation for 2017. This presentation was made at the Blue Ball Barn in Wilmington, Delaware. Many Affinity clients, though, are from all over the cities across the country, so we're making this highlight presentation available to keep you informed of our current outlook. The stock market is at record level, and certainly the Trump experience is different than anything most investors have been through. So what is the outlook going forward after 4 months of strong gains in most investment accounts? Before we do that, though, let me remind you of some considerations about this presentation. The information provided here is really for general information purposes. It really shouldn't be considered individualized recommendations or personal investment advice. The investment strategies mentioned here may not be suitable for everyone. Each investor needs to review an investment strategy for his or her own particular situation with their advisor before making any investment decision. This presentation contains forward-looking statements which might not prove to be accurate. All investments can lose money in certain market conditions, and risk should always be considered carefully. So our overall view at the beginning here, our big message tonight is that there are opportunities of several types, even though this is one of the longest market recoveries in history, and even though the stock market is setting records. The value of the stock market is always relative to what else you can invest in, and relative to the earnings of corporate America and the economy. So we're going to break down what's happening, but we believe that this year is one in which we might really build portfolio values. With low returns from bonds and sluggish returns in real estate, this market might well continue the long recovery in stock values because the alternatives to stocks are not very attractive. So here's what we're going to discuss briefly. We're going to look at what happened in 2016. We're going to look at what factors affected the markets. We're going to look at what changed since last year and where are we now. And what do we see as the trends and indicators for the rest of 2017. So let's look at last year. The year began with a stock sell-off. Then we were coming off of a year really before that really the indexes had lost a small amount of ground. But it was the fears of the Chinese economy that were strong, and the Shanghai index dropped about 7% on the first trading day of the year. The U.S. markets experienced their worst ever start to the year in January and February. Finally, by February, they were down 14.5%. Before they finally rebounded when they revised the GDP estimates up and suddenly realized that the consumer was actually starting to spend. Growth continued at a relatively solid pace, though not blistering. But then we got the first political surprise last year on June 23rd, Brexit. Few people expected the British to vote to leave the European Common Market, but that's exactly what they did. And for 4 days, the global markets reacted strongly to that shock, but then they quickly stabilized again. Our last talk was in September, and we said that we thought the market might have one more leg up, but if you'll remember, we talked about Mount Everest and how Sherpas guide climbers that last little, somewhat deadly section to try and get to the top, and we thought the market was a little bit like that it had another leg up, but it could be dangerous given where corporate earnings were. So we were fairly defensive up until the November timeframe. And this is what we were worried about. We had had 6 straight declines starting in late 2014 all the way through 2015. And we felt like one more quarter of weak earnings would cause the market to topple. But earnings did begin to turn, and that changed everything. So even without the addition of any Trump considerations, you can now see that the forecast is for pretty positive earnings increases. And so this recovery, just based on corporate earnings, looks at. And then the next big surprise was that Trump did indeed get elected, and he proposed three things that will clearly boost stocks if they were to happen. One is corporate tax relief, which is an immediate benefit with more money going to shareholders. Secondly, there's a proposal to deregulate banks and let them back into some of their most lucrative product areas. And third, there's a possibility of an investment in infrastructure, which would help both industrial America as well as creating a lot of jobs. We see corporate tax relief as pretty likely, actually. Bank deregulation may be happening to some degree, but not as likely as the corporate tax relief. And we think actually some infrastructure boost is likely to get done as well. But of all of these, it's really corporate tax reform. If that happens, this is going to be a significant spark to the markets. Changed last year. For the first half of the year, as you know, Affinity is increasingly using sectors and overweighting sectors to help us add value. And we were in the right place for most of the first half of the year because we held utilities, because we were defensive, and we held consumer staples. And we had some healthcare as well because it's also defensive. But then we switched later in the year when we began to be more bullish. We switched to financials, more technologies. We had held on to our healthcare all through that. But that turned out to be a good move because financials really were extremely strong performers, and the technology overweighting turned out to be strong as well. But we did hold on to the healthcare through all that because of some of the things we talked about last year with the aging of the population, and healthcare was only at 9 times earnings. That turned out to be a good bet. We still have some healthcare, and healthcare is one of the leading performers here in 2017 so far. So when we began 2016, here are the sort of estimates of the experts, some of the larger organizations, and altogether, it may be surprising, but they were looking for about a 7.2% growth rate, even though we started out the year so weakly. That turned out to be not quite so accurate in that the market actually turned in about 9.5% growth. So even though that was a pretty optimistic call, the market actually did even better than expected last year. But there are some other forces shaping this market, and let's just touch on a couple of these briefly. Jobs last year ended up with 75th straight month of growth. That's a pretty extended employment run. There are a lot of ways to pick at those job numbers, but the fact is 75 straight months of employment growth is a big positive for the market. And that dropped the unemployment rate below 5% to 4.7%. And we're finally seeing wage pressure, which means people will have more money to spend. So employment is clearly a green light. One of the steady positives is in the industrial side. The industrial manufacturing in the U.S. is only about 15 to 18% of the U.S. economy. But it's continued to rise. It's using fewer workers, a lot more robots. But when you add in oil and gas as part of our manufacturing capabilities, the U.S. has quite a steady strengthening there. Here's one way to think of this. This really looks at U.S. manufacturing. You see it's the yellow in the middle of the chart. And then it looks at U.S. oil and gas slightly to the right. U.S. manufacturing is actually larger. It would, if you just looked at it by itself, it would be the 10th largest economy. In other words, just U.S. manufacturing is larger than the entire economy of India or Canada. So you see that although we don't feature in our service economy manufacturing, it's actually a very powerful force, and the indications in that sector are pretty strong. And then oil and gas, we could continue to be a strong player there, as you see. Oil and gas would be the 17th largest economy if it stood by itself. So the U.S. has a strong underlying force that's very positive. We don't think oil is going to be that strong. We went into oil in the fall, made a nice quick gain, but then we exited because we don't see oil getting above $60 a barrel, and it wouldn't surprise us if it slid down around 40, only because the U.S. is so good at creating new supply whenever the price starts rising. The other positive right now is that unlike the beginning of, say, January of 2015, we're starting to see global growth finally rebounding. It has taken quite a while. If you look at the left side of this chart, this is a heat map of all the different economies in the world. And green is good and yellow and red are bad. And you can see there's a lot of yellow and red if you go back into 2015. But if you look at the last column where the arrow is, you see an awful lot of green showing that the indicators for manufacturing and for economics throughout the world are looking much improved. So the U.S. is not the only growth, to carry the whole growth wave. So that's a positive for the U.S. as well. At our last meeting, we talked a lot about inflation being held down by the aging population of the U.S. and, in fact, the global aging of population. And one of the things that does is keep inflation down. And you can see that inflation has stayed very, very low, down around 1%, 1.5%. But finally, we actually are having a pickup in inflation up to 2.5%. 2.5% is not a robust number. And we still think that the aging population and a lot of other factors, the global environment, will keep inflation below 3%. But even at 2.5%, we could see 2 more rate increases as the Fed tries to make sure that inflation does not get out of hand. So this is a change and something we have to watch. But here's our favorite indicator, and that's consumer sentiment. Because 2/3 of our economy is really driven by the consumer, when you see strong consumer sentiment, the economy is going to probably be okay. And we don't usually ever get recessions when we get a green signal from consumer sentiment. And right now, starting in November, this number started to really move up positive. And actually, it was the best consumer sentiment in January that we have seen in more than 10 years. Now, in February, it dropped back just a tiny bit, but as long as this number is above 90, we're very positive about the economy. And you can see why, going from October to November, we suddenly got very bullish in a hurry and changed to a more aggressive stance. So over time, all the things we're talking about could change again. But here's an interesting series of charts, and I'll go through this quickly. But here's the January 2008. Here are just the whole host of things that we're tracking to see what kind of situation we have in the economy. And you can see that this is kind of a mixed bag. There are a few cautions. There's some red that you have to watch out. And so this is one that would start to get our attention. So this is January of 2008. But then let's look at December of 2008. As we go into 2009, you can see that this thing turned into a sea of red. And so we had a warning that the market was going to probably deteriorate, as it did, of course, with one of the biggest falls that we've seen in market history. But the point here is that we really do see warning signs when we start to get near a recession. And that would probably happen again. And it's also very interesting if we then look like now. And you can see why we are so positive. You have kind of a sea of green here. And the things that are showing red are the political environment, some of the crazy headlines that you're seeing every other day. But that's not one of the more powerful drivers. You can see so many different indicators that look positive. That's why we're looking for a pretty good year. The other thing that makes us even more confident, let's look at the individual household. The top chart shows that the consumer is having to spend less money than they've spent in quite a while on paying their monthly debts, whatever their debt, credit card, mortgage, and so forth, is down to only about 10% of their monthly budget. So they're in pretty good shape on a monthly cash flow. And the bottom chart shows that thanks to this run-up in the stock market and the recovery in their housing prices, they're actually in pretty good shape on a net worth basis. So that's why they're so confident. When the consumer's in this kind of shape, we don't. So we've talked a lot about stocks, but let's talk about bonds, because with that inflation number, we're probably going to get a couple of rate hikes this year. And again, we're always reminding you that whenever the yields rates rise, bond prices go down. So therefore, we're very challenged to make sure we manage the bond portfolio effectively. And we've done that very well. We're beating the indexes on the fixed income side fairly handily over the last 6 months. And the reason is that the indexes for bonds have to hold government bonds, which are interest rate sensitive. But we've used floating rates, we've used bullets, all of which help us deal with the rise in interest rates. Very little of the portfolio in bonds is affected by interest rates right now because we really don't want to have interest rates rise and bonds go down. And if you also have our private alternative investments, if you're qualified for those, I'm happy to report that all the 4 or 5, SQN, Resource, Shop Off, and the Preferred are all doing well. And we can give you an update on that if you'd like to give us a call. But the alternatives that produce income have also, that's another strategy some of you are using. But we're doing a pretty good job with managing bonds. So we'd look to get maybe 3 or 4% out of the bond side of the investments. The experts saying about 2017, we showed you last year. This year, they're saying that we're probably going to get about a 4% growth. And most of these predictions are from last month because as we go into March here, we're already up really approaching 6%. And our view is that they've probably underestimated again like they did last year. If we get, it really will depend on rate hikes, I think. If we get 3 rate hikes, then we might only get a couple % more. But we think it's more likely we're going to get maybe 2 interest rate hikes, in which case we think this market could produce another 5 or 6% on top of what it's done already. If we would just get 1 rate hike and the Fed would stop, then this market could really put up some bigger numbers. But let's assume we get the 2 hikes. That's what we're positioned for, which means we may get another 4 or 5% on top of the approximately 6% that we have at this point. So that's going to be a good year to build account value. And people say, yeah, but isn't the market really overvalued? And that's really relative. This is looking since 1958. So you see where we are on inflation. We're at 2 to 3%. When we're at 2 to 3% inflation, usually the average PE is over 17, approaching 18. That's about where we are now. So we're a little above average. We're maybe more like 18. But you can see that it's not at all. We've gone as high as 20, almost 27. Over periods when we've had this kind of low inflation. So I really expect that even if we go up above 20 times earnings on forward earnings, that the market is only slightly highly valued. And given the low interest rates and the alternatives, I really think that we could have additional market action without being way out of line on valuation. So our view of what's on the horizon is that we're in an extended market opportunity, and we're going to try to make the most of that. If it does start to deteriorate, you see that we are watching the signs, and we would be able to react to that. But we're pretty positive at this point that given the economics and maybe even some help from Trump, that we're going to have a pretty good year here. And we will certainly keep you posted and welcome any of your questions. Just contact your advisor if you'd like to know more on any of these topics. I want to close by thanking you. Affinity has some of the most loyal clients you could ask for. Even when we were playing defense and not going for return last year, you were very patient. And I'm happy to report that over the last 3 or 4 months, most accounts have had a nice improvement in performance. And we'll try to keep that up for you. Thanks for your attention.